2022 was a rough year for investors, no doubt about that. The S&P 500 was down by about 19 to 20% for the year, and the tech sector has been even worse, with the tech-heavy Nasdaq being down around 30% or so year to date. But that's not all. Bonds have also struggled, in part due to the fact that the Fed has been hiking rates so much this year. The Vanguard short-term Treasury bond index fund is down around 5%. While the intermediate and long-term Treasury funds are down by about 11 and 28% respectively, at least at the time of this recording. Sure, their yields have risen to a degree alongside the Fed's rate hikes, but it's still rough. Not to mention being highly unusual from a historical perspective. To put it into a historical perspective, based on data from Ed McQuarrie and Yale economist and professor Robert Shiller, there has only been 14 other instances prior to this year where both stocks and bonds have been down in the same year. Now that may sound like a lot, but this is a data set that goes back all the way to around 1794. So we're talking a total of 15 instances over the course of nearly 230 years of market history. That's about once every 15 years or so on average. So quite unusual to say the least. Naturally, after a tough year like this one, many investors are asking themselves the question, what happens next? Or will my investments go down again next year, given the possibility of a recession looming? Unfortunately, none of us have a crystal ball, so those are both questions that we can't answer with 100% certainty, no matter how hard we try. However, in times like these, I often find that it's helpful to look back at history to see what typically happens following environments similar to the ones that we've been living through recently, in order to help prepare myself, at the very least in the mental and emotional sense, if not the outright financial sense, for what might be coming down the pike. So that's what we're going to be doing today. Let's take a look back through market history to figure out what usually happens following a year in which stocks and bonds struggle simultaneously. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. In this video, we're going to be looking at a combined data set based on the work of Ed McQuarrie and Robert Shiller to get a general idea of how well the overall stock and bond markets have fared following down years. But first, it might be helpful to get a baseline so that we can appreciate how much better or worse the markets have done relative to any normal year in these types of situations. So, at least based on this data set, the stock market has experienced dips in roughly 25% of all available years since 1794. Bonds have declined in roughly 13% of all available years. So about 1 in every 4 years for the stock market are down, and 1 in every 8 or so for bonds. On average, stocks have experienced average annualized returns before inflation of roughly 9 to 10% per year, while bonds have experienced returns of about 5 to 6% per year on average. In years when stocks are down, they're typically down by around 11%, again, before accounting for inflation. Bonds are typically down by about 3% in those same situations. In the years following a down market, stocks typically rise by about 10%, and bonds by about 8.5%. In both cases, the results are at least slightly above the long-term average, which makes sense given that in order to reach that long-term average, you have to make up for those losses that you just experienced. So that's the baseline scenario, and sort of an answer to the first question of what typically happens next. Normally, following a down year in the markets, they rebound, and on average, those rebounds tend to be better years for the market than the long-term average would suggest. Again, normally. But of course, this year was worse than a normal down year. Again, stocks are usually down around 11% or so in the years when they are actually down. This year, depending on what index you're looking at, you could be staring down the barrel of upwards of a 30% loss. A similar thing could be said for bonds, so it's worth asking the question, what typically happens after major down years? Say downturns of 20% or more, since that's the typical threshold for a market crash and is roughly what the S&P 500 has fallen by this year. In addition to that, we can also start to try and answer the other question we posed a minute ago. How likely is it for the stock and or bond market to be down in back-to-back years. And how severe is it when it does fall twice in a row? Starting with stocks, there were 16 instances in which the markets fell in consecutive years. Given that there were 56 down years in total, this dataset suggests that roughly 30% of the time, the markets will experience a dip in consecutive years. In those years where the markets fall for a second straight time, they typically fall by a little more than the average for a normal down year. In the case of stocks, the average drop in down years that followed a dip the previous year was about 14%. However, it is worth noting that the average is dragged up a bit by a couple of really rough examples. For instance, during the Great Depression of the early 1930s, the markets dropped initially by about 11%, which is fairly standard for down years in the stock market. But this was followed up by a 28% drop the following year and a further 44% drop the year after that. Especially when we're dealing with a sample size of some 16 examples, those few outliers can drag the average up a decent amount. In reality, the median loss was about 10%, as nearly half of this sample, 7 of the 16 instances, managed to cap its losses to single digits in the years following market drops, and 11 of the 16 instances did better at capping their losses than the overall average drop would suggest. In the years following a back-to-back drop in the markets, stocks rebounded by an average of about 10.5%, and unlike the previous example where the average made it look worse than it actually is in most cases, the average actually undersells the typical outcome a little bit in this case. The majority of the 16 instances actually posted better than 10.5% returns, and the median return in those situations was about 14%. The reason for this discrepancy between the average and median return is because there were some cases where the market fell for a few years in a row, such as during the Great Depression like we just discussed earlier. Bonds, as one would expect, have experienced less turbulence than stocks historically. Based on this dataset, there have only been 5 occasions where bonds have experienced back-to-back down years, and given that they've experienced roughly 29 down years overall, that suggests that roughly 1 out of every 6 years has ended up translating into consecutive losses. What's more, none of those 5 occasions saw a third straight down year. In those 5 instances where bonds experienced consecutive losses, the average drop was a little over 3%. The year following a second straight loss, bonds typically recovered extremely well, posting average returns of roughly 20%. So they didn't experience back-to-back losses very often, but on those rare occasions when they do, they tend to rebound in that third year very well. So, as you can see, in general, there are more up years for both stocks and bonds than there are down years. And even in situations where we are coming off of a down year, the majority of the time, the following year is at least positive. On average, the year following a downturn, regardless of whether that downturn lasted for 1 year or more than 1 year, is actually better than your run-of-the-mill average year in both markets. However, as I mentioned in the previous section, it's worth taking a look at the figures following major market downturns, because it's one thing to bounce back from a year where your investments drop by 3, 4, or 5%, and quite another to bounce back after a downturn of 20 or 30% or more. So how does the narrative change when we're looking at only the years following major market drops? Let's get bonds out of the way first this time, because there was only one instance where they experienced a drop of even 10%, let alone 20. That instance came in 1842, when the bond market fell by approximately 23%. The year following that downturn, bonds lost an additional 7%, though it is worth noting that the year after that 7% drop, the markets rebounded with a 50% gain and did not experience another down year until 1855. So assuming you had invested into the bond market before that initial drop in 1842 and held your investments until 1855, your average annualized rate of return during that period would have been about 7% per year before inflation, which is not too far off of the long-term average. In fact, it's slightly above it. The stock market has a bit more data to go on, although it is still a fairly small sample size. Based on this dataset, since 1794, stocks have experienced 20% losses or worse in 8 different years. In 3 of those 8 instances, the markets were down the following year by an average of about 19%. Though, just like before, it is worth noting, the Great Depression is kind of distorting the data, with a 44% drop following the initial crash in the early 1930s. Other 2 instances experienced losses of 5 and 8% respectively. So the average drop looks pretty darn bad, but really it's just being dragged up by what happened in that one instance during the Great Depression. That's just something that happens sometimes with small sample sizes. In the 5 instances where the markets rebounded following that initial crash, the rebound was typically very strong, and the signal is pretty darn consistent. The markets rose by 39% following the 1908 crash, 28% following the 1938 crash, 38% following the 1975 downturn, 31% coming out of the dot-com crash, and about 29% coming out of the depths of the Great Recession. So there's not too much distorting of the averages here. All 5 instances were in that upper 20s to upper 30s range, which is a return that I would gladly take in pretty much any year. So in the end, for the stock market anyway, the story remains largely the same as it was without the major downturn filter, even if it is a bit more extreme in the numbers. In the majority of cases, the markets tend to rebound following a down year, and those rebounds tend to produce above average returns. But with that being said, there are those rare instances, such as the early 1840s and during the Great Depression, where the markets really struggled to bounce back from a down year. What if we had something like that play out again? It's entirely possible, even if I wouldn't go so far as to say it's statistically probable. But if that is something that you're worried about, you can always make an effort to further diversify your investment portfolio. There's a reason that so many financial experts recommend diversifying your investments. It's because you can significantly lower your risks of a horrific outcome as an investor, while still managing to capture the bulk of the returns you would have earned had you not diversified as well. Let's take a look at a simple, classic 60% stock, 40% bond portfolio to get a general idea of what I mean here. A 60-40 stock-bond split lowers our chances of having a down year in any given year to about 21%. Compared to about 25% for an all-stock approach. It lowers our number of instances where we would have experienced losses in back-to-back years down to 13, or a little over a quarter of the number of down years overall, compared to 16 with an all-stock approach. And it cuts the number of crash years where the markets fall by at least 20% in half, down to just 4, of which only 2 experienced losses in the following years. Those years were 1842 to 43 and 1932 to 33, and both of those losses were single digits at just 6.1% and 0.2% respectively, compared to stocks, which experienced post-crash losses of up to 44% in that 1932 to 33 period. Perhaps more importantly, though, is what it does to the average losses in these down years. On average, the 60-40 stock-bond approach falls by about 7% in years where it experiences a downturn. It falls by about 9.5% in the year following a loss when back-to-back losses end up occurring. The 4 crash years all held their losses to no more than 27%, and it accomplished all of this while sacrificing only about 1.4% per year in average annual returns. Now that's certainly not nothing, especially if you're young and just getting started investing in your early 20s or 30s, because you have a lot of time for that money to grow and compound. And there are things you could do to potentially mitigate more of that long-term return drop, as we've covered in previous series on this channel, but given the amount of risk reduction, especially in those worst-case scenarios of crashes that are then followed by additional down years, since those are the situations where it'd be most tempting to give up on an investment strategy or exit the markets entirely, it could be worth it for a lot of people. So while we don't know what tomorrow will bring in the markets, what we can say is this: more often than not, the markets grow. And that's the case both in normal times and in years following down markets, even when those down markets are fairly severe. And thankfully, there are things that we can do to lower our risk of experiencing consecutive down years, such as by looking into further diversifying our portfolio. Even something as simple as adding in some bonds to go with our stocks can be surprisingly effective. But I'll leave you with this. In the nearly 230 years that this dataset covered, there was only one time that stocks and bonds were down in consecutive years simultaneously. That was in the 1842 to 43 time period. Stocks lost nearly 30% in 1842 and about 5.5% in 1843. Bonds lost nearly 23% in 1842 and about 7% in 1843. Both posted gains of at least 38% the following year. Bonds didn't experience another down year until 1855, and even stocks made it all the way to 1849 before falling again, a year in which stocks lost just 0.4%. So if you take nothing else away from this video, let it be this. As rough as this last year was for investors, and it was pretty rough, tough times like this usually don't stick around for much longer than a couple of years or so. And when the recovery does eventually come, it tends to be pretty robust. So if it is at all possible for you to do so in your situation, just stay the course. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. If you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.